the Fed announced that it was ending the BTFP, or the Bank Term Funding Program, and that was on March 11th, and now that's coming up pretty fast. And what have we been seeing? NYCB, or New York Community Bancorp, has been just collapsing all over the place. And we saw in the last 24 hours, it literally came down 42.3% within 30 minutes. But it sought to raise $1 billion worth of capital, and this capital represents 1% of its total assets. A mere 2 hours later, it reopened. And it rallied severely. But concept is, this is really problematic. We're starting to see cracks in the banking system. Many people say that your money is safe in the banks, and when you look at the banks, Silicon Valley Bank, New York Community Bank, which JP Morgan voted New York Community Bank as the top regional bank pick for 2024, it's only come down 88% in the past 12 months. Why am I mentioning this? When it comes to Bitcoin, Bitcoin started to rally from that particular Fed announcement of the end of the Bank Term Funding Program. It's not by mistake that the institutions are weighing heavily into crypto, and specifically into Bitcoin. One thing to note from LV31 from the masterclass, when we look at central bank balance sheets, there is restriction pretty much across Europe and the US. All of the central banks are tightening their monetary policy. Notice what China has been doing recently. It's pushing a huge amount of stimulus into the market. And this is what China does. It's very erratic with its central bank policies. They come up and down all the time. And when you notice the other countries, they're much more linear in fashion. How is the US banking system going at the current time? We can see that JP Morgan is doing really well. Look at JP Morgan. It's just going for it. It's one of the best performing banks. Citizen Financial not doing so well, and First Republic Bank is deceased. When looking across the regional banking sector, we can see there's a degree of weakness in the regional banking sector, but unfortunately, New York Community Bancorp, over the past 35 days, it's decreased in value down to its low from its peak, around 84%. And Signature Bank, once a $400 per share bank, actually declined to little over 0.0001 cent. First Republic Bank, which was trading around $200, is now deceased. The thing to be aware of, the Fed is closing out the emergency bank lending program on March 11th. You can expect intermarket volatility across this period of time, and we've already seen a degree of volatility inside the crypto market. New York Community Bancorp, we can see that its price structure has been under tremendous pressure of late. The Bank Term Funding Program has been seeing increases in the amount of money borrowed, and you can see it's in excess of $160 billion in 2024, and that tap is about to be turned off. The tap getting turned off has implications for trading and investing. First of all, the tap turning off will increase systemic risk inside the banking system and put positive pressure on yields and the DXY. If that happens, you can expect retracements in the main markets. This means we need to look at the structural levels on the DXY, the US 10-year yield and the US 2-year yield. They're very, very important to track. When people are new to trading and investing, it can be a real roller coaster. Prices go up and down primarily because of the interdependence and interrelationships between Tier 1, Tier 2 and Tier 3 charts. For example, how the DXY moves will impact the major indices and the stocks. How yields and bonds move will impact crypto, commodities, and the stock market. As an investor or a trader, and the best of the best combine both approaches. Right now, please keep your eye on the DXY and also the US 2-year and the US 10-year yields. Specifically, we need to look for either a breakdown in structure or a break up in structure. The biggest problem that every investor and trader will face is how to know where the structural support and resistance levels actually are. And when we look at the DXY, it's been trading in excess of 20,500 days. Let's just pop on the indicator and see what's cooking. Interpreting CTKS structure is literally a license to print money. What you can see in here, it's like price charts have a geological formation. If they can't get above structural levels, they're going to the ones below, especially major confluence of structure. If they get above, they're seeking to come up to the next structural level. But if they can't make it and can't make it above, they're coming back to the ones below. What you'll notice here is that we lost this structural level on the DXY. Notice this retest, backside, undertest, and just decaying down. But we know where the structure is inside the market, and this is vitally important to know. Many people use moving averages, and let's just pop on some EMAs. EMAs have a lot of use. They tell you what retail is looking at, but they don't tell you where the structural overhead resistance levels actually are, how strong they are, how congregated they are. They don't tell you a lot of things. They don't tell you where structural support is, and they don't tell you a myriad of things. What an EMA does, or a simple moving average, it just averages price over a number of periods. It is backwards looking, not forwards looking. The mathematics of finance is based on probability, and probabilities have one of two indicators. They have lagging indicators which look backwards, or leading indicators which look forwards. The secret is, get the leading indicator. Lagging indicators such as moving averages look backwards. It's like trying to drive a car forwards by looking in the rearview mirror. Not such a good idea. You need a leading indicator to see where price can go. The DXY, the US 10-year and the US 2-year are very important to keep your eye on a daily basis. It doesn't matter if you're investing or trading, they're really important. What did we notice with the US 10-year yield, which has been trading in excess of 40,000 days? Well, we've seen the price come down. Now let's throw on a statistical measure. A moving average. Remember that moving averages are backwards looking measures. What do we see here? We can see a number of the moving averages are above the current price. Well, all of them are above the current price, but there's a conglomeration, a mass of them way above there. Now let's look at the leading indicator. Because we know that moving averages are statistical based measures that just literally sum up past price behavior. They don't really tell you where the structure is inside the market. Looking at our forward indicator, we can see that the US 10-year was under severe stress. It was coming back and testing some very powerful areas of structural support, but it broke through. Now, what's it going to do? When it breaks through so much structure, it's going to have to get caught by a lot of safety nets, and those safety nets manage to catch price. But if it can't come back into this area, it's going down to the next levels of structure. And you can see these were fairly light levels. This is a stronger level. And you can see how incredibly well structure is supportive of price action. It almost pings it. And this is what you want to bear in mind. When you're looking at any price chart, make sure that you understand the structure, but then make sure that you understand how one chart relates to another chart. For example, if the DXY is coming down, the US 10-year is coming down. Guess what crypto is doing? It's rallying. In all probability. The rally inside crypto has been largely attributed to the decay in the DXY and the US 2 and the US 10. With the BTFP coming to a close, that could all change around because the banks will look at the increased risk of borrowings. And when they transfer funds between each other, they're going to need to be compensated for the additional risk of default and also bank runs. This means that we could see positive pressure and momentum on the US 2-year, the US 10-year and the DXY. This is important to understand. The rallies that have been occurring inside crypto are largely as a result of the 2, the 10, and the DXY decaying. I know a lot of people think, oh no, Ken, it's the ETFs. The ETFs are doing it. And that is true to a degree. But the ETFs are institutional funds, and institutions always look at cross correlations and they look at market dimensions. They're not retail. Let's have a look at the structure in the US 2-year yield, and we can see it's been trading for more than 13,000 days. Typically what you will see is retail analysis or retail technical analysis. It will just draw up peaks and troughs between recent price action or recent indicative price, which is RIP, your money, and you don't want to do that. Because if you just take a fraction of the price behavior, you'll find that you only have a fraction of the understanding of what price is doing. When we pop on the leading indicator of price, what do we see? The US 2-year just couldn't get above all of this overhead structural resistance, and you can see it's really tough. There's so much of it there. Therefore, it got pushed down into support and couldn't get back above it. What does that mean? If it's not going above, it's going below. And if it can't get through this type of structure, it's going below to lower safety nets. And we can see it came back and it didn't even test that upper boundary. It is decaying at the current time, but it's also consolidating. One of the things to bear in mind is the US 2-year, the US 10-year, and the DXY. They all relate primarily to government policy, especially the yields. If the Fed comes in and says, oh, the banks are looking, not too good, and we can see systemic risk inside the banking system, it may extend the bank term funding program, which would be really good. But even when the GFC was occurring, everybody was saying, oh, everything's fine, nothing to see here, don't worry about it. What we need to do as traders and investors is keep our eye on the cross correlations. Don't pay too much attention to the media. Pay attention to structure and pay attention to interdependencies. You want to trade and invest independent of market sentiment. This is very important. Just rely on structure. It's probably not surprising that we're seeing a large degree of volatility inside the crypto market. When the markets get turbulent, you can expect turbulence inside crypto as well. What we need to do right now is to turn on our X-ray vision of the structural levels of Bitcoin to understand its movements better. Any breakage of structural support is something that you need to pay attention to. We had a bit of a cracking of the concrete here, and we've had it here as well. What does that basically mean? We've come into structural support, but it didn't hold, and it's been maintaining a weakness. We did manage to liquidate a lot of shorts, but then it went exactly the opposite way. All of these safety nets that you can identify act as trampolines to capture price and just see if it can come up or it's starting to move down again. When you get a big sell wave, you can expect to move through a lot of safety nets, especially the lighter ones, until you get to heavier ones, which are magnetized by nature. They can form bottoming patterns inside price action. This is why you need to know where the structure is. It's very simple to understand structure. If it's going above, it's going to the next one. If it's going into a cluster, it's going to have difficulty trying to get through that. You'll find consolidation action in these times. Another cracking of the concrete, which indicates that the buyers are simply not inside the market. Things are not being supported as we would hope them to be at the current time. When we look at current price around that 66,200 mark, we must bypass structural resistance at 66,936 and seek to make our way above into this positive fresh air gap. That will open up the 71,824 structural resistance level. That is the bullish case. Whenever investing and trading, it's important to have your three-dimensional thinking at all times. If we find the bearish case coming up to retest the 66,900 mark and failing, Also underside retesting of the 65,893. We do have a degree of structural support inside the market and a lot of structural support at 62,131. But the bearish case is the more likely case at the current time because we're finding we just can't exceed this 67,200 mark. We need to trade above that to open up the bullish case. Please keep in mind, the bear market for crypto is well and truly dead. It is over. And the bullish case for Bitcoin is superb. I would suggest that this is the last opportunity, if prices go down, to get in and lean in to really great projects at better prices. What typically happens is people see negative price momentum, they sell everything, they buy back at positive price momentum, and as soon as it goes red, they sell it again. This is the death of 1,000 cuts and the retail mindset. Please don't do that. Please go the exact opposite way. Buy at structural levels. Know what the structure is. Know how structure is related to price. And use the forward indicators of structure to tell you what to look for next. Always keep an optimistic and open attitude to the direction that price can go. Price can consolidate, it can move up, or it can move down. And you've seen the price moved down and then moved up. It moved down and then moved up. It moved down. You get the idea. Just a very simplistic concept. If you want one direction as to where price is going, well, it could be going up, could be going down, up, down. It depends where you buy and where you sell in terms of your effectiveness as a trader or investor. And the best of the best combine both. What you typically want to do is just to take full advantage of these retracements and set your targets as to what you want to accomplish. With trading, we can set annualized targeted return on investments around structural levels to do exceptionally well. As an investor, you want a dollar cost average in on strong structure. But to do that, you need to know where it is. Just a bit of housekeeping for the monthly service. All the Tier 1, Tier 2 and Tier 3 TradingView private indicators are out for the CTKS method monthly service. Also, there's one video that covers all of these structural levels, including the up case, the neutral case, and the down case. Please pay attention to the US 10-year, the US 2-year, and the DXY this month. They're going to be critical to understand. If you're a member of the service, just go into Bitcoin to view that all-in-one video for the current month. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again in the next video. Bye for now.